around 80% of students will never pay back their loans in full.
Wow.
Okay? Hey guys, the student loan system in England is unpopular among students, taxpayers, and the government. As a result of the pandemic and huge pressures on public finances, the government now wants students to bear a much higher proportion of student loan costs. It is estimated by the government that around 54% of the money that it lends will never be repaid. As you can see from that screenshot, the government's very keen to reduce the so-called RAB charge or the RAB charge, which stands for Resource Accounting and Budgeting, which is an indicator of the proportion of the government's loans which are marked to be written off. There are suggestions that the government plans to do this by reducing the threshold by which you'd normally be required to pay back your student loans. The current threshold stands at £27,295, and there are suggestions that this might be reduced to £23,000 at the next budget, leading to more people becoming eligible to pay back their student loans. In addition, there are concerns that this might even be applied retrospectively, which would be a massive disaster on many levels, because this would be quite an injustice to the very many people who believe they had signed effectively a contract to take out a student loan.
And all this comes at a time when inflation is rising, and on top of that, there have been recent announcements that national insurance will rise, which will affect us all. So this is raising questions for many people, which is that should you repay back student loans early or not? And some parents are wondering, should they prepay the student loans for their children or not? So today we want to take a deep dive into the subject of student loans. We're going to split this video into 3 parts. So part 1, we want to outline how the student loans system works in England in a Q&A style.
Yeah, this is going to be pretty detailed, guys, so please do be patient because we really want to unpack. For those of you who don't actually understand how the student loan system works in this country, this is a really good opportunity and a video that you can come back to in the future if you ever really wanted to understand how the system works.
And in part 2, we want to look at the possible implications of the repayment threshold being reduced to £23,000. And in part 3, we'll be discussing whether you should pay back your student loans early or not. So for those of you who are new to this channel, I'm Mary.
And I'm Ken.
Of the Humble Penny and Financial Joy Academy. And what we do on this channel is to give you the tips, the insights and the practical hacks to help you work towards a dream life of financial independence and money joy. Okay, so let's dive straight in.
All right, so for part 1, let's talk about the student loan system here in England.
Right, so how much does it cost to go to uni for 3 years in England?
Well, that's a really good question. And that question leads to a lot of confusion for a lot of people because student loans are massively politicized in this country. And a big confusion for people is a misunderstanding between how much they have built up in student loans versus how much they actually pay eventually. So at present, the tuition fees in England stand at around £9,250 per year, a maximum of that amount. And this is paid by the student loan company when you become a student. Now at that level, assuming £9,250, if you did a 3-year course, that works out to be £27,750 worth of tuition fees. But that's not the end, because of course you go to university, you've got to live, you've got living costs associated with going to university. Now the living costs come in the form of a maintenance loan, which according to the government's website, the amount you get varies depending on whether, number 1, you are living at home, number 2, whether you are living away from home but outside London, number 3, if you are living away from home but inside London for university, and number 4, you are spending a year of a UK course studying abroad. I'm just going to pop on the screen a screenshot for you guys to kind of see what levels of maintenance loans one can expect to get as a student. Now this means if we made a simple assumption that a student studying for 3 years, they're living away from home outside of London, according to that screenshot, you would see that they could get a maintenance loan of up to £9,488 per year. Now, if you take that amount and multiply that by 3, that works out to be £28,464 worth of maintenance loans over 3 years, which if you don't take that and add that to the tuition fees I mentioned earlier, over 3 years of £27,750, you would have in this example a total student loan debt in this example of £56,214.
Wow.
Now that total then becomes a student loan after somebody has graduated, okay? So you're not worrying about the loan whilst you're at uni, it becomes a loan that's attributed to your name in effect once you've graduated. Now that amount is likely going to be even higher if you're somebody who is studying within London and as a result of that have high living costs as you'd expect in a city like London. And of course that number is before you then add the likes of interest, which then begins to accrue on the debt, as well as the impact of inflation as time passes. So how do they decide how much maintenance loan you get?
Well, at the age of 18, you're obviously an adult. However, how much maintenance loan you get for your living costs is decided by your parents' taxable income plus your own, if you make any. So it's basically means tested. So we went to check this out ourselves on the government website. So I tested this myself and typed in £65,000 joint parental income. So the results show, as you can see, that around this total household income, you will be entitled to around 50% of the maximum £9,488 maintenance loan for somebody who, through the example that we used, studied outside of London. This means if you're living in an area for uni, which costs 9k per year, you will have a shortfall of around 50% of that amount, meaning that your parents will have to foot the rest of the 50%. Now, if your parents can't fund this for you, then getting a part-time job is a good idea because it also helps you to develop a good work ethic. Another important thing worth pointing out is that the means testing does not factor in parental debt. You could have a situation where your parents are high earners, but they have a lot of debt. And although your parents are struggling to get by, you end up with a fraction of the maintenance loan as a result. So what is the key decider for how much of your actual student loans you pay back?
Okay, so for a lot of people who are yet to go to university, student loans is a big worry. They're worried about taking on a lot of debt and even thinking should they go to university or not. And for a lot of people who are already at university or people who have been through uni and now have student loans, they're worried psychologically about the mounting amount of debt that they've got. But the thing to realise is that the key decider for how much you're actually going to pay back is your levels of earnings. So how much you are earning from when you graduate from your degree. So the current rules state that you repay 9% of everything in excess of the current salary threshold, which stands at £27,295. Now that particular threshold relates to what's known as the Plan 2 loan, which are loans that you've taken out for degrees after the 1st of September 2012. Now related to that threshold are other thresholds for other types of student loans, whether they be Plan 1, or Plan 4, or for those who've done post-grad degrees. And you can see they've got different amounts there. Specifically, Plan 1, as I mentioned earlier, are for those who started their undergrad degrees before the 1st of September 2012. Plan 2 are for those who started on or after the 1st of September 2012. Plan 4 relates to Scottish students, and then you've got the postgraduate level there as well. Okay, let's now look at some practical examples.
So up on the screen, we've put up an illustration and you can see 5 different columns. So the first column is just a key as to how we worked out the calculations. The second column is the different categories. Third, the fourth and the fifth column are different scenarios based on different earnings. So let's look at it. So for somebody earning £30,000, you'll see that the threshold is the same regardless of the salary that you're earning. The threshold is £27,295. So 30,000 less the threshold is £2,705. So 9% of that £2,705 is £243 per year in student loan repayments, and that works out to be £20 per month. Let's look at somebody who earns £50,000 per year. So £50,000 less the threshold of £27,295 leaves you with £22,705. So 9% of the £22,705 leaves you with £2,043. Somebody earning £50,000 annually will pay student loan repayments of £2,043 per year, or £170 per month. Okay, so now let's look at the high earners, somebody who's earning 100k. So 100k less the threshold of 27,295 is 72,705. 9% of that is £6,543. So somebody earning 100k ends up paying £6,543 per year, which works out to be £545 per month. So essentially what you repay is in direct proportion to how much you earn. So this means that if you have a £50,000 debt of student loans, for example, and you earn £27,295 or below, i.e. the current threshold, then you don't have to pay anything back yet. If you're going to remain a low earner, then you won't ever have to pay anything back.
And this is a really important point, essentially, which is that if you've got that huge amount of debt that you're looking at right now, but your earnings are quite low below that threshold, then it's not really that big pile of debt that matters, but it's the fact that you only pay above, pay 9% above that threshold.
Exactly.
Yeah.
Okay, so when do student loans get wiped off?
Great question. This really depends on when you finish your degree. So if you are currently on the Plan 2 loan, which are for the people who started their degrees on or after the 1st of September 2012, then your loans get wiped off completely 30 years following the April after you graduated. So the April after you graduated, 30 years following that. So say, for example, you're someone who's 18 years old when you went to university, you finished uni at, say, 21 on a 3-year degree, then at the age of 51, your loans will be completely wiped off if you still had some left over.
So what about the slightly older folk like you?
Older folk?
Who went to uni before 2012? What about them?
Okay, so for people like me who went to uni in 2002 and finished in 2005/6, there's a different plan for student loans for those who've got student loans. So people like us would fall into the Plan 1 student loans, Plan 1 loans. You see up on the screen there, took out a loan in 2005/6 or earlier. Then, interestingly, your loan does not get wiped until the age of 65.
Wow,
okay?
Big difference.
Which, exactly, be quite a surprise to a lot of people. But interestingly, if you took out a loan in 2006/7 all the way to that 2012 cutoff of 1st of September, just before, between those two dates, then, according to this, your loans get written off within 25 years following the April from when you first are due to repay. So 25 years.
Yeah.
For the people who are in between 2006/7 and 2012, but for the people who are on Plan 2, is it the new loans and people who are starting university right now, people who are currently at uni right now, and people who went to uni after 2012 in September, those people will have those written off, as I mentioned earlier, in 30 years, okay? So how do you repay the maintenance loans?
Well, you repay the maintenance loans the same way that you repay your student loans. So your maintenance loans plus your student loans gets added together to form one number. And as mentioned earlier, if you earn over £27,295, you will pay 9% of any amounts over that in student loan repayments. Okay, so what percentage of people actually pay off all their student loan debt plus maintenance loan plus interest within the 30 years?
Okay, so really, really good question. According to a recent piece by the Institute for Physical Studies, according to them, they've estimated that around 80% of students will never pay back their loans in full.
Wow.
Okay, 80%. So that's 4 out of 5 people of you guys watching this video right now will never pay back your student loans in full, which means that only 1 in 5 people, you know,
the high earners,
the really high earners, and 1 in 5 people will actually pay off their student loans in full. Which, again, let's remember what that implies, because if only 1 in 5 are paying it back in full, then it means the rest of the student loans are really being funded by the taxpayer. Which, again, if we extend that thought a bit more, it means really that for the vast majority of people watching this video right now, the amount of student loans you're seeing on your statement right now, however large that number is actually completely irrelevant.
Yeah.
Because the amount you actually eventually pay for 80%, 8 out of 10 people, will be less than the full amount that you actually borrowed.
Right.
Okay? So the psychological aspect here is that we should stop worrying so much, per se, about the amount of student loans that we're seeing mounting, but instead put our focus on the fact that really and truly, according to the current rules, and rules do change, but according to rules, you are required to pay 9% of everything over that threshold of £27,295.
Yeah, according to the current rules.
Yeah, it's really not a loan in the typical sense, but it's more of a student tax, more of a graduate tax, if anything.
So how do tax and students' loan payments differ from graduates versus non-graduates?
Okay, so up on the screen is an illustration for us to look at, okay? So on there you can see the first column is looking at different potential income levels. Second and third column in the kind of yellowish colour are the columns for the non-graduates, so someone who's chosen not to go to university and instead do something else, follow a different path, which is completely valid, by the way. And the final two columns to the right in green are for the graduate. Okay, so on row number 1, which is for anyone earning between 0 and 12,570, we all know that's the personal allowance level, so there's no income tax due there. So for the non-graduate and the graduate, you can see there is no tax to pay, so 0. The second row, where we've got 12,571 to 27,295, which is the threshold from which you start paying back student loans, you can see that for the non-graduate, they are paying this 20% basic rate tax, and for the graduate, because they've not exceeded that threshold, are also paying their basic rate tax to the right hand side. Then next you've got the range from 27,296 to £50,270. So this is where basic rate's being paid, but for the graduate, you look to the right hand side, they're not just paying 20%, but they're also paying the 9% because they're now earning above that threshold for which they are required to start to pay back their student loans. You can see their charge in a year is 29% compared to the 20% for the non-graduate. Then that trend carries on from £50,271 to £150,000, where one's treated as being a high rate taxpayer. You can see the non-graduate is paying 40% tax, but the graduate is paying that additional 9% again, a total of 49%. And then finally, for the super high earner, in this scenario, who is earning above 150k, the non-grad here will be paying 45% additional rate of tax, but the graduate will be paying total of 54%, being 45% plus a 9% student loan charge above the threshold for their income. In effect, the whole point of us showing you this illustration is to kind of help us to see that what really happens when you take out a student loan is that you're in effect paying an additional charge, which in this case is 9%. And this illustration clearly shows us that in effect what we're seeing here is more reinforcement of this idea that a student loan is not really a loan in the typical commercial sense, although it's dressed up as one, but in reality, in substance, it's actually more like you paying an additional rate of tax.
Yeah. Okay, so how do the changes to national insurance affect take-home pay?
Okay, so we mentioned earlier that there have been some increases in national insurance announced recently linked to a new social care levy that has been introduced. So in effect, every employee and employer is now paying an additional 1.25% in national insurance to begin in April 2022. Okay, so that hasn't started yet, but it's coming. This means that employees NI, which used to be 12%, is now expected to be at 13.25%. So that has implications because, not only are we paying tax normally from our paid income tax, but if you've got a student loan, you're now paying that additional 9% over the threshold. But in addition to that, there's, of course, now this higher level of national insurance that everybody, whether you've got student loans or not, will also have to pay. So up on the screen, it's the same screenshot we had before, but updated to take effect of the impact of national insurance, just for us to see what impact it actually has on take-home pay for people, whether you are a graduate or a non-graduate. Again, the same colors relate to non-grads and grads, and you can see really that from the third row, you start to notice quite significant differences. So first of all, for the non-grad, they're paying the basic rate tax and the 13.25 for national insurance. That's really what they're paying. At basic rates, at higher rates, you can see they're paying 40% plus a 13.25%. So they're paying 53.25% thereabouts of their income, okay? Is what they're paying out. You can see at an additional rate, they're paying 45% plus 13.25, which gives us 58.25%. Again, for the grad, you're adding that 9%, okay? Each time, if you exceed the threshold of £27,295, you can see that what you're paying out each month when you add 20% basic rate, 9% student loans, and 13.25% of NI, when that kicks in fully, is 42.25%. If you're someone who becomes a higher rate taxpayer, that number jumps up to around 62.25%, because here you've got the higher, you're being taxed now at a higher rate for a certain level of your income. So 40% plus 9% plus 13.25%. And then that jumps even higher to 67.25% if you are an additional rate taxpayer, again factoring in the high level of national insurance that we expect to be paying from April 22 onwards. All right, so let's talk about what interest rates you pay on student loans. Do you want to talk about that?
Yes, so interest rates on student loans are linked to RPI rate of inflation, not CPI. So up on the screen, here is what the government looks at what it charges for interest on student loans. So you can see that the rate of interest that you get charged on your debt depends on how much you earn. If you earn less than a magic £27,295, your student loan only increases by RPI. If you earn over this amount and start paying your student loan repayments, you pay RPI plus 3%. Same at above £49,130 in income. Note that the key implication to bear in mind here is that the real cost impact is the additional 3%. So if you're earning below £27,295, then there is no real cost impact to that, as the debt is only increasing by RPI, as is likely your income. Is going to uni with a student loan worth it?
Okay, that's a big question, and it really depends. In our opinion, going to uni is a good thing. If you're somebody who's going to be a high earner, then we'd argue that it's still worth it, because you've been able to create for yourself a good career. And of course, as the current system shows us, those who earn the most pay the most when it comes to student loans. If you end up becoming a low earner, even after going to university with student loans, then the system again shows us that you actually pay next to nothing back, because if you earn below the current threshold, you actually don't pay a penny back at all. However, if you're going to become a mid-level earner, then the chances are, when you've factored in all the bits you have to pay back in student loans, then there might be situations where you might actually be worse off than somebody who has not gone to university and instead pursued a different path. That is a possibility to bear in mind. But note that when thinking about this decision on whether it's actually worth it going to university with student loans, the rewards of going to university far exceed just the financial rewards of how much you're going to earn. You form some really good friendships at university. We did when we went to uni, and some of our closest friends even today are still friends that we had from university. Yeah. You of course learn at university, you make some really good connections at university, and you might even, if you're lucky, one of the very lucky few, meet your future life partner at university, as has been the case for some people. And there's so many more other benefits, such as the levels of confidence you develop from going to university and things like that. So there are many things to try and weigh up in deciding whether it's worth it actually going to uni by taking out a student loan. Now, there are of course those people who are very fortunate in that their families have enough in wealth that they can pay for their children not to get involved with the student loan system at all, and those children might end up being some of the highest earners. So for those people, it's a win-win, because they've completely avoided the student loan system, and then they've ended up becoming really high earners down the line. One thing would suggest, if you're somebody who is thinking ahead, perhaps either for your own children, or you're not quite there yet when it comes to going to university, then using tools such as a junior ISA as a way to begin to save is a good thing to consider. If you are working part-time perhaps, or if you have family members who want to contribute into a junior ISA for you on your behalf, then a tax-efficient tool such as a junior ISA is a good way to try to reduce some of that burden when it comes to student loans, particularly if you're somebody who believes you're going to become a mid to high level earner into the future. Using a junior ISA and building up some savings, as is the case in other parts of the world, across the pond in America, a lot of people start to save a lot of money and put money aside for their children's future higher education. So if we did more of that in this country, we might actually see more people taking on less student loan debt and potentially less of a burden on the state. Okay, but again, this is coming from a place of some privilege. You have to have some privilege in that being able to put aside money is something you're actually able to do or your family is able to do. And we're completely aware that that's something that's not available to everybody. But you guys, let us know what you think in the comments actually. Do you think it's actually worth it going to university and taking on a student loan? What are your personal thoughts? Let us know in the comments, and do hang around, because at the end of this video we're going to be sharing with you guys whether we think, if you've got student loans right now, whether you should be overpaying those and trying to pay them off earlier or not. Alright, so let's now talk about the potential impact of the government reducing the threshold for repaying your student loans, which at the moment is £27,295. You're talking about potentially reducing it to £23,000. What would be the impact of that?
Yes, so we read here a report according to the Institute for Fiscal Studies, which we'll put links to below. Doing this would hit graduates with middling earnings the most. The lowest earning borrowers will be largely unaffected, as they will pay back little either way, unless the threshold for the loan interest rates were changed at the same time. The highest earning borrowers would end up paying less.
Wow, okay.
Yep, as they would pay off their loans more quickly and thus accumulate less interest.
Okay, so because they started paying off their loans a lot quicker, the power of compounding doesn't work as much, meaning that they'll pay off their debts quicker.
Right.
So in effect, them reducing this threshold, if it does happen, it would seem to, as you've read there, really help the high earners a little bit. And hit the people who are earning in the middle.
Yes.
Which is quite a concern, really.
Of course.
Because that doesn't, that's not having the right effect. Because that's bringing more people into paying student loans.
Yes.
And essentially passing on the burden from the state onto more students.
Graduates. Yeah.
What do you guys think about that, actually? It'd be interesting to know. Obviously, we expect you not to be happy about it, but tell us what you actually think about the move being made.
Let us know, guys. Okay, so the question that we tend to get asked all the time is, should you pay back your student loans early?
Okay, fab question. And there are a number of scenarios we're going to look at to actually come to some conclusion as to what way to proceed, okay? So the first scenario is scenario one, where you are an extremely low income earning graduate, okay? Let's say that you earn below £27,295 and you're going to be earning below that throughout your working life, okay? So in that scenario, you went to uni and you graduated, but you never earned above the repayment threshold in the 30 years before your loan gets written off, okay? In that scenario, you will of course pay back nothing. So trying to overpay or any attempt like that will be a waste of money down the drain. So in that scenario, do not try to overpay or pay back a thing early at all. Now, scenario two is where you are a low-income graduate, so earning a bit above the threshold, so a bit above that £27,295. Say, for example, you are earning around £30,000, but throughout your working life. Now, I know some of these scenarios might be unrealistic because inflation and things like that happens over time, but we need to go through these scenarios for us to have a sense for how we might come to a decision for ourselves, okay? So in that scenario, you would start paying back some of your student loans because you're earning above the threshold. So it would be 9% of the excess over £27,295, which would work out to be £243.45 a year. So this, of course, is tiny relative to how much you might have in student loans. According to research, the average student loan amount being held in England is at least £45,000 per graduate. Okay, so if you're paying back at this level of income of £30,000, assuming that stays like that, then you're only paying back a fraction, £243, which is a tiny fraction of the loan itself, let alone the compounding or accruing interest elements that usually is what makes these loans get bigger and bigger over time. So in that scenario, it will not make sense, of course, to be overpaying because if you expect your level of income to stay at that level, then it will make no sense whatsoever to try and pay back your student loans early. Now, for scenario 3 though, which is very interesting, again, back to our source we mentioned earlier, the Institute for Fiscal Studies, they have a rule of thumb, which I found to be fascinating. And the rule of thumb is that they estimate that if you earn around £50,000 by the age of 30 and you're looking to remain in your career, the chances are, they say, you will pay back more than you borrowed if you repay on schedule. That says quite a lot to us, okay? That's giving us a clue already as to how we might make a decision here. So they estimate that around 1/3 of people earning £40,000 by the age of 30 will pay back more than they borrowed in real terms due to accrued interest. Then those numbers change and go from 1/3 of people, graduates, to around 2/3 of people who are earning 50k by the age of 30 are estimated that they will pay back more than they borrowed in real terms during their working lives. Now, what's interesting about that is that the age of 30 is used as a good proxy because by the age of 30, for a lot of people have some ideas about their future careers. Their careers are somewhat beginning to become established and you begin to have a sense for whether you're going to have a successful career in the future or not. So they're using that benchmark of 50k by the age of 30 to determine that. Given what we know, according to the Institute for Fiscal Studies, if you're somebody who's earning about £52,000 by the age of 30, which by the way will be a small percentage of people, because that amount far exceeds the average income in the country, given the estimated chance that you will pay more than you actually borrowed, being 2/3, coming back to our question of should we pay back the thing early or not, we would say that at that level of income, you want to start to do a bit more maths, i.e. you want to start to really consider this as a possible option. Not necessarily saying go ahead and do it straight away, but you want to start to have it at the back of your mind. But before you start to pull that trigger and do it, you want to prioritize some really important things, such as have you saved up enough for your deposit for a home, for example? Have you paid off expensive debts in your life, such as credit cards and those sort of things? Have you put away money for an emergency fund? Those sorts of things. If you've done all those things and you've got a bit more money left and you're earning at that level of income above that 50k, just above and so on, then you might want to become that person who starts to look into this as a possible option to consider. But it's worth mentioning again that according to the research, they mentioned that the estimate is that around 2/3 of people will pay more than they borrowed in real terms, which of course leaves around 1/3 of people who at that level of income will not pay back more than they have borrowed. So again, at that level of income, as middle earners, like we say, it is worth considering. And our final scenario are for our high earners, okay? So you might remember the statistic we had earlier where we said 80% of people will not be paying back their student loans in full, which meant that around 20%, of 1 in 5, will, without a doubt, be paying back completely in full, the full borrowing and full interest, okay? So the 1 in 5 people, if you owe one of those people well in excess of £50,000, then this is something to really, really consider. The idea of actually overpaying should become more of a serious consideration at this stage. If you're on that trajectory of being able to earn 50k and above by the age of 30 and so on, and you're in that 1 in 5, then our suggestion would be that you should take overpaying your student loans or paying them back early to be a serious consideration. Prioritizing, you purchasing a home, we would say is a key thing to do. Prioritizing, making sure you've paid off expensive debts, things like that. And then of course, if you carry on becoming a really high earner and you have an excess income left over, then you might want to take it seriously and commit some of that income towards paying back your student loans early. You have to be one of those people in the 20% of high earners who this will likely benefit, because without a doubt, you will be paying back all your student loans and all related costs such as interest costs.
Guys, please don't forget to subscribe to this channel if you love this video, and why not share this video with someone else who you know has a student loan. So guys, what further questions do you have for us about student loans? Let us know in a comment section below and we'll jump in there and answer your questions.
Absolutely. Guys, thank you so much for watching today's video, and as ever, in all things,
be thankful and seek joy. Take care.
Take care.
Bye.
Bye.